All right, guys. Well, let's get this party started. It's 3:30. Welcome to another free educational webinar with Option Hotline. This afternoon, we're happy to host Bubba Horwitz. He's here with you guys, going to talk to you about hedging your portfolio. I know he's got a lot to talk about. He's got a good presentation all geared up, so I won't waste your time making you listen to me. So, Bubba, I know you've been talking to everyone already, so why don't you go ahead? I'm going to stop sharing my screen and you can go ahead and start sharing yours.
Okay.
So go to the share button.
This one.
And then you want to pick a monitor.
And share screen. And now you can see my presentation, right?
Now I see it. Yep.
All right. And this is not free. It'll cost you all one beer to come in here. So anyways, what's up, everybody? Welcome aboard. And some of you have seen bits and pieces of this, but of course with me, they're always new each and every time. And welcome to what we call your life-changing event, the ultimate hedging of your portfolio. Anyways, before I can really get started, you have to read this disclosure or disclaimer, whatever they call it. I'm not equipped to read the whole thing. I give you guys 10 seconds to look it over and read it and know that options and futures have risk. That's, I guess, really what it says. But you can know that now, and then we can just move right along. I am Todd Bubba Horwitz. For those of you who don't know me, I've been doing this for 39 years. I've been a member of all three exchanges, still currently a member of the CBOT or the CME. They're the same thing now, but at one time they weren't. I'm the founder and author of Bubba Trading, Options Made Easy, Bubba's Guide to Trading Options. Regular contributor to Fox Business, CNBC, Bloomberg, BNN, RFD, Phoenix TV of China, Kitco News, and Yahoo. I was on today. I have my own radio show every day. And of course, I was the original market maker, one of the original market makers in the SPX. I have done some co-hosting with Mornings with Maria, but today is about you. And what I always tell everybody is do something today that your future self will thank you for. It's about you. This is not about me. I already know how to do this. I've done it. I understand it. I want you to understand, and I want you to be able to do it because this is a long-term solution to a short-term problem. All right, and I retire on Friday. I haven't saved a dime. Here's your chance to become a legend. These are the things that you need to do to protect yourself in the future, right? We've all been through, I don't know if we've all been, but if you're old enough, you've been through 08, 01, 87. They happen all the time. And no matter what anybody tells you, it's never different. It's going to happen again, okay? But the idea is not to have to make a decision to get emotional about those things when they do happen. So this is a long-term solution to put your emotions in check. We are from the school, I am from the school, that you should always be hedged because when you're hedged, and you will see as we go through the presentation, the benefits of hedging and how they actually benefit you and help you do better than if you didn't hedge. Now, you've always heard the story, we've all heard the story that if you never sold and you just held, your portfolio would grow over time because the markets do go up on average 8% year over year. They don't go up every year 8%, but they over the average run of the market for 150 years, the average gain is about 8%. But if you're hedged, you can actually compound that. But the biggest thing we always make the mistake is by dumping and puking out, as they say, that's a very technical trader's term, at the bottom of all markets. Okay. Anyways, before we actually get started, I want you to ask yourself two questions. How would I like to never have to sell a stock ever again? Okay. Would I like to benefit from the next correction? Okay. Those are two questions for you to think about as we're going through this presentation. Hi, Bob. I just met my 6-month future self, and boy, did he thank me. Why, you ask? Because 6 months ago, I took the Bubba hedging course. I set up 2 portfolios. The first one was all Apple, or as my girlfriend says, did you roll any fruit around today? Hedge to itself. This portfolio is now up 14.8%, and I own 11.5% more stock. The second one is all QQQ, or as my girlfriend says, how the Q babies do today. Hedge to itself. This portfolio is up 11%, and I own 11.9% more stock. All these numbers are net after all commissions, fees, and interest. I have not added any additional cash out of my pocket. I use margin for roll-ups and keep my cash invested. It takes me about 30 to 45 minutes a week to maintain these. Most of the time is playing the market with market makers to get the credit or debit I want. But most important, I never worry about what the market is doing, and I sleep very soundly. I can't wait to meet my one-year future self. Thank you so much for putting it together and sharing it. All right, so today we're going to talk about protect, preserve, prosper, and compound. Your choices. What is hedging? Why hedge? Trading strategies that you've used in the past. The importance of hedging your portfolio. Choices again. portfolio protection myths, strategy, phases of the market, our software, and how you can take advantage now. And of course, as always, I will answer all of your questions. So we always need to be prepared, okay? I talk about this in everything that I do because there's many different types of trading that I do, that we all do, okay? Day trading or trading as a swing trader is not either the same as hedging your portfolio. Swing trading and day trading are not the same, so you got to have a plan. So we want to plan, protect, and prosper. And how do we do that? It's by learning how to use protection, because the markets themselves, okay, are the greatest single compounding tool ever known to mankind. Better than banks, better than anything. And if you understand how to do it and what to do, and it's not complicated, but by simply being able to stay inside of the market, you can compound your portfolio. And of course, Albert Einstein says compound interest is the eighth wonder of the world. He who understands it earns it. He who doesn't pays it. And if you happen to remember, when I was a kid, somebody came up to me one day and said, will you give me a penny every day and double the amount every single day? And everybody said, oh, sure, that's easy. Do you realize that if you did that, it works out to be $5 million after a month? Okay, by doubling a penny every day. And that's the goal, and that's the accomplishment we're trying to get done through hedging our portfolio, is to be able to allow ourselves to compound these portfolios, obviously not at $5 million, but at that type of rate. And it works the way it works because it's a strictly mathematically based formula. It has nothing to do with your opinion, my opinion, anybody's opinion. You can be in any stock that's liquid, any group of stocks, as long as they're liquid, you can do whatever you want and you never have to sell a stock again. And that's where it brings into the choices that you have, okay? You can sell your portfolio in the cash market, never a good decision. You can ask your family astrologer. Sometimes that might work, but probably not too good. You can do nothing and observe your portfolio eroding, or you can use index derivatives to hedge your portfolio, which is what we do and what we want you to learn how to do, because that's how important it is. And I've been doing it for my mom's portfolio, just for example, since 2009, when my father passed away. I've been taking care of her portfolio, and she's just having a time of her life. She's now 90. September 1929. There is no cause to worry. The high tide of prosperity will continue. Oh, I guess he made a mistake, right? And of course, that's one of the things that, it's like in sports, the coach gets the vote of confidence with a pat on the back, and 2 weeks later he gets fired. Well, this happens all the time. If you go back and look before any market collapse, we are getting reassured that everything is okay. So what I always tell everybody is don't panic, relax, whether you hedge or not, okay? The worst thing you can ever do in a market is panic, okay? That's the worst decision. Actually, there's two things that are bad. You can chase the market up, or you can puke it out and chase it down, okay? The best thing to do is to sit back and take a deep breath. And I wrote this on August 24th, okay, 2 years ago, when the market was collapsing, all right, on a Monday. I said, I know this morning is not pleasant for most of us because the market collapse that we've been seeing the last few days. I want you to take a step back and a deep breath, evaluate and relax, okay? Remember, there's no cause to worry. You have to put yourself in a position, and at worst case, you have to take a deep breath, because how many of you have ever said something to somebody that the minute those words came out of your mouth, you wish you could take them back? That's what I always recommend. Sit back and take a deep breath first before you do anything. What is hedging? Hedging is like an insurance policy, okay? You're offsetting the potential risk that can be out there in the markets, okay? You are protecting yourself from a downfall. Now, most people will say, well, why don't you just buy puts, okay, and you'll be protected? Well, you're really not protected, because if you just buy puts, you have to pay a lot of premium. And if you go back to the year 2014, when all the experts were saying, hey, just buy cheap puts, which the first thing is you want to understand is there's no such thing as a cheap option. Options are all fairly priced unless they're expensive. Remember, who's on the other side of your trade? Every trade we make, there has to be a buyer and a seller, so there's somebody on the other side. In our case, it's usually the market maker. You don't think they're giving anything away, do you? Of course, the answer is no, they're not giving anything away. So cheap options should not be a term in your vernacular. When you look at it, okay, in 2014, the market was up 21%. Those who took the advice of the pundits and the other people made 3%. That's how much it costs to cover that hedge. We don't want that. We don't want to give up that kind of hedge. We want to get as much capitalization out of the market as we can get. Why hedge? Because you if you've got an advisor now, or if you've done some of your own trading, and you go, geez, I got to move from this. It's a seller's market. It's a buyer's market. I got to move out of this, risk on, risk off. I got to go to bonds. You don't have to do any of that. Okay. None of that. If we could do any of that, okay, if we could put together any of those things and knew when it was the right time to be risk on or risk off, we wouldn't need to do anything. We'd all be multi-billionaires because we'd always be right. The case is that they're churning money. That's what they're trying to do. And they want to keep you invested in the market. So they got to move you from one asset class to another. The bottom line is you can buy today Amazon, okay, at the height of the market at $2,050, and you can hedge that to about a 1.5% to 2% risk, okay, on a stock that's making all-time new highs every single day. That's the position that we want to be in, not in a position where we're trying to figure out what's the next place to move our money to. A, it costs us money to keep moving it around, and B, what if we're wrong? Portfolio protection myths, okay? Covered calls, and I will get into these later, but they are the worst strategy to mankind. 30 years ago, they were fine. They were about the only thing you could do. Today, the worst strategy to mankind. Protective put. It's pretty close to a covered call, but if you weren't going to do anything, I would say, okay, gold and other precious metals. Look, I'm an owner of precious metals. I like them, but they are not protection against your portfolio. Okay, I don't care what anybody tells you. Gold and silver and any other precious metal is nothing more than another hard asset. It does not protect against a panic or a problem. They're good to own because they're a nice asset class. But if you're buying for protection, you're going to be just the same crap that you've always been in. Try to pick tops and bottoms. No, we know how that works. And I can tell you from thousands and thousands and thousands of dollars I've lost trying to pick tops and bottoms, it doesn't work. You can hope and pray, which many do, or you can panic. Okay, on this sheet here, there are no good choices. Okay, some are worse than others. October 14th, 1929. The Commerce Department today denied rumors that a severe depression in business and industrial activity it was impending, which had been based on mistaken interpretation of a review by industrial and credit conditions issued earlier by the Federal Reserve Board. The geniuses of the Federal Reserve, even back in 1929, were causing the same trouble they're going to cause today. Okay, this was 2 weeks before the crash. Market corrections, we all know they're going to happen. Okay, let's not be foolish. Okay, and believe that they're not going to happen. Okay, they are going to happen. There is no way. There's no ifs, ands, or buts about it. Market corrections happen. Okay. It's to what degree? When they're less than 5%, nobody gets nervous. Okay, 5 to 10, maybe you can buy. A full correction, you got to start getting nervous, like we saw in January and February. A bear market, a little bit of panic, crash, we know, and then depression. Pack up the kids, right? But again, we don't have to worry about that, and that's the beauty of what we're trying to share with you today. Is none of those things are important. We don't have to worry. Carl, I see you got your hand up. Okay, and I lost my chat board. Oh, here it is. Let me see if I can get it back up here. Hold on. Where'd it go? I can't find it. If you could type it in the Q&A, I'd be happy to answer it. I just can't see where it's at right now.
Yeah, Bubba, I just let everyone know if they have questions to put it in the Q&A or chat box, and you can answer them at the end.
Well, the chat box, I can't find. I lost my chat box somewhere.
Oh, okay, then the Q&A.
Anyways, and this is a chart. This is 1929, 1930, and now. Again, I don't want anybody to think that I'm trying to create panic, because I'm not. If you listen to my updates I do every day, I say, I don't think the market's going down yet. I don't think it's ready. And one thing we do know for sure is what? It doesn't make an announcement. Things just happen. And before you know it, it's too late. So it's better to be prepared instead of waiting to chase it down when it's all over. Why do you need protection? Well, we're all emotional. Okay. I'm not emotional. I'm as calm as they get, but you got to eliminate the emotions out of this business. Trading itself is a game, and those who can control their emotions win the game. Avoid fear or panic selling. Keep your long-term portfolio intact. Create potential yield. Those are all things that we're going to get to today. Dear Bubba, Never thought I'd be happy about a 40-point drop in the stock, but thanks to you, I've added 16 shares of Facebook this morning. As my niece in Columbus would say, how brown is that gravy? Thank you for teaching us your ultimate defense. Your greatest admirer, Marianne. And again, she was able to buy 16 more shares of Facebook at 162, okay? And it's now 171 or whatever it was down today. But in the meantime, able to buy more stock. And I have one guy, just for kicks, that started with 1,000 shares of Facebook that he bought at $100. Today, he's got 1,465 shares of Facebook and never was at risk in the entire trade, more than a couple of percentage points. Keep your head in the game, okay? In hedging, you keep a long-term perspective. You know that the mathematical model that you're using works for it. Don't panic when the market falls. Don't let tax considerations determine your strategy. You know, I had this conversation with a lot of people in 2011 when Apple was 700 and CNBC had that special ticker. And I was actually on Bloomberg in September when Apple put their earnings out. And at that time, it was a record quarter for any company in the world. Okay. And everybody's going to Apple's going to 1,000. Boom, boom, boom. They come to me and I go, I'm a seller here. I think it's going back down probably to, 400 or 500. As it turns out, it went down to 350. Now it has come all the way back, but wouldn't it have been nicer to sell it up towards the top if you were going to do that and then rebuy it back? Okay. But again, we all worry about the taxes. Well, sometimes you can take a position that's such a big winner and then it goes down below where you bought it. You don't have to worry about the taxes anymore. You can't outsmart the market by timing trades. Okay. Now, strategies that many of you used in the past, the covered call. I started with this in the original. Now, covered calls today are a joke because of the cost to trade, because of the cost to get involved in the market. Okay. A covered call, what you're really doing is you're not protecting yourself. You are limiting your upside. Okay. Because if you have Apple at $220 and you sell, like, let's say a $240 call, okay, and you get, let's say, $1 for 6 months worth of time. Okay. Well, if Apple goes through 240, you're out at 240. Okay. And you had no protection to the downside. You had $1 worth of protection if it went down. What kind of protection is that? Selling covered calls is only a yield building strategy, but you'd rather sell call spreads if you want to create some type of yield building. Buying married puts. Again, if you weren't going to do anything, I could live with it, but you pay way too much premium to buy married puts. It's just not a great strategy. And of course, there's the collar. All right. Now, I don't know if anybody knows what a collar is, but a quick explanation is a collar is, in your view, the trade is over. Okay. When you collar off a stock, which means if you own the stock, you buy a put, you sell a call, you're out. The trade is over. Okay. You can't lose money. You cannot make money. Okay. Now, ARBs, like when I was on the floor, we could ARB that and make a few pennies, but for the average retail trader, the trade is over. Now, I'm going to teach you a better way to do the collar that allows you to participate in the market if it keeps going higher, and how to benefit if it goes lower to add more stock. In the meantime, doing the same exact thing that a collar does. The only thing a collar really does is if you had a stock that you wanted to sell, you could collar it until the next year, the next calendar year, and then sell it versus and putting your tax treatment out about 14 to 18 months. Market corrections, how will this one end? Who knows? It's going to end eventually, but it could, listen, the market could go up to another day, a week, a month, a year, 2 years. Nobody knows the answer to that question. Okay. But there are a lot of warning signs. Margin debt is at record highs. What does that mean to everybody? Well, margin debt is that people are buying stock without their own money. They're using margin. Now, if you've ever seen the movie Trading Place, and margin calls, they don't happen as much as they used to, the way they used to, because of the computers. But in the old days, you could see at 2 o'clock or 3 o'clock Eastern, when margin calls are coming in the markets, that's what would sell the markets off late because people had to meet their calls or get out of the stock. Credit card debt is at record highs. Interest rates are starting to rise. The Fed has absolutely no clue what's going on. Commodities are crashing, and they'll blame it on the trade wars, but they've been crashing long before the trade war talk. China's in trouble. Okay, this is what I call a house of cards. And of course, you hear this, and I heard this, I can't tell you how many times I've heard this on air. This time is different. It's never different from tulip mania and before all the way through today. Now, if you just look at these charts real quick, everyone that's going down is bad and everyone that's going up is bad. Okay. Now, again, that doesn't mean anything today and it may not mean anything tomorrow, but it just means that we all know what's going to happen because in 87, now I happen to trade through 87. I was on the floor then, caught most economists and scholars and investment professionals by surprise. Nowhere in the classical equilibrium-based view of markets so long considered inviolate was there anything that would predict or even describe the events of 1987. Well, I got to tell you something, okay? I didn't know it was happening. I mean, I knew something was happening, and I knew that the markets were going to go lower. I had no idea it was going to go 33%. But there was a prognosticator back in those days that starting in the month of August, every day he wrote on the closing comments of his thing, sell, 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 sell. Because again, markets get to a certain point, they have to reach equilibrium. And this is what the Fed and all the economists don't get. They only get what they can read in a book. They only get theory. Protect your money. Could this happen again? This itself, the actual crash of, for example, of 87 could never happen again the way that it happened. And the reason is very simple. Because in today's world, they put circuit breakers in. Now, does anybody know, just out of curiosity, why they put circuit breakers in? William, I will get that, I promise, when I'm finished. No worries. I will definitely answer that for you. Okay? Does anybody know why they put circuit breakers in? Okay? Well, I'll tell you what. They put them right. Very good, Will. They put them in because what do I take? Take a deep breath. The circuit breakers make you take a deep breath, and usually that can calm the markets down. That's why, for example, I think it was 3 years ago, IBM's earnings used to come out after the close, and overnight and during the day that we're going to bring the earnings out in the morning. You knew that our IBM was going to get clobbered the next morning. And how did we know that? Because they wanted to make sure they could open that stock into a liquid market in the morning versus let everybody fester overnight. Now, I'm a big believer in what we call and what I call universal price. Okay. And what that means is all markets are the same, all charts are the same, all patterns repeat. The shortest time frame always resolves itself into the longer time frame. Okay. So what we talk about is the phases of the market. The market goes through many different phases. And so what we're going to do is real quick, I'm going to switch to my bat cave here, and we're going to actually look at it. And I'm going to create this a little bit faster because obviously we don't have all that time. But in the meantime, the market goes through phases. Okay. The most common phase of the market is what they call consolidation. Okay. Markets consolidate about 65% of the time. And I'm just trying to find a clearer pattern so that you understand the concept of what it is. But markets consolidate and typically will churn back and forth. And we've seen that over time. If we looked at a longer term chart, just to give you the consolidation pattern, you can see that this is really just one big consolidating pattern. We're turning up and down between, the low point and the high point and going back and forth. Eventually, congestion will cease and the markets will break out, and they will either break out up or down and break out to a trend. Okay. So when they break to a trend, the congestion or consolidation is the birth of a market. The breakout now becomes the life of the market. Okay. So if we use this chart, so we consolidated, we broke to the downside, and then eventually, after the trend is going, typically most markets will end with what we call a blow off. Okay. And a blow off is when price and time become meaningless and nobody cares about price or time anymore. They're just panicking. They got to get out or they got to get in, either way. But here we saw two opportunities for a blow off. Here the markets blew off, came back up and consolidated again. And then they really blew up to the downside. And of course, then we got a rally out of it. We got a V-shaped recovery. Now, if you look at a much longer term frame, because as I say, these happen on all markets, okay, on all charts and on all time frames. So if we look at a monthly chart, which we know how long a month is, that's a lifetime. But if we look at a monthly chart, okay, look what happened. This is '09. This is the bottom. The markets were in. They blew off to the downside on a monthly basis. They then rallied, made a little bit of a V-shaped recovery. They then consolidated. They then broke out to the trend, consolidated again, and broke out. And then in January, they had a blow off to the upside, and we've been consolidating ever since. So either we are going to break out of this consolidation and continue the rally, or we're going to get a blow off to the downside. Which one, I don't know. I would suspect it'll be to the downside, but I'm not predicting because, again, that's not what we do. But those are the phases of the market. All markets go through that, whether it's soybeans or it's Apple or it's the weather. It doesn't matter. They all go through the same thing because it happens over and over again because all markets repeat themselves. This is just the typical maze of what happens, okay? Markets are born in optimism. They get crazy. Then euphoria hits in. And if you remember the movie, I go back to the Trading Places because I love these movies. But if you remember when the Duke brothers looked at each other and go, that can't be right. Well, that's what investors say. As soon as the market peaks and it starts to sell off a little bit and they buy in and it doesn't go up right away, that can't be right. And of course, then they go in denial, fear, and desperation, panic. And then the whole cycle starts over again. It goes over and over and over again. That's the way the markets work. Won't change. Nothing will change that. But how do you protect your portfolio? So I put together a little bit of a sample hedge for you, okay? And this is assuming $500,000 of the S&P stocks. Now, this can be one stock that you could hedge to yourself. It could be $500,000 worth of the S&P or the spiders. It can be a group of stocks, okay? It really depends. This is what we talk about in the class, but it depends on what you are looking for and what you want to do, okay? In the meantime, the first part of this trade is we buy a 1/2 put ratio out in time. We use the cycle of triple witching expiration. Once an option, once a hedge gets in within 30 days of the triple witching cycle, we roll to the next quarter. So we were in September. We now rolled to December. All right, that's the next in the cycle. It's December, March, June, and September. So we bought the December 285. We sold the December 285 put. We bought twice as many 283 puts. So we had a net long of 18 puts, which actually would add up to about $500,000. You multiplied 283 times 30 times 18. That cost us $5.59 as a debit. We then sold an iron condor because we don't want to pay that money. We want to finance that money if we can. And the beauty here, now I'm not typically an iron condor kind of guy. I don't believe in them. However, in this model, because it's all mathematically based, what do I know for a fact? Yes, I sell an iron condor that's $2 wide. I'm collecting, in this case, 65 cents of a credit. So I've got a $1.35 risk on either side. However, if the market explodes to the upside, I give up a $1.35 profit, but my long position that I own covers that up and I'm making money. If the market collapses, my 1/2 ratio covers that up and I'm getting money to go back in and buy more stock. So it doesn't really matter. We aren't really taking the true risk of the iron condor. We're using it as part of a mathematical equation. This is what the trade looks like. 18/36, 285, 283, and then the iron condor. Now the cost of that trade for $500,000 is $11,000, almost $12,000. Okay, so figure it out. Okay, 12,000. It's about 2.25%. Okay, to totally hedge your portfolio. Now what we're going to do is each and every week we're going to sell an iron condor against that position. We're going to try to finance out and collect $65 a week in this case. We usually try to get 80, but this was a credit at the time. $65 a week times however many weeks we got. We're going to try to collect that each and every week and add to our overall yield of that position, okay? Because we want to enhance our yield. Because at the end, we want to make more money than the market's going to let us make. Now, from pure mathematical certainty, okay, the amount hedged was $500,000. The cost of protection was $11,000. Actually, it was $11,900, but $11,400. Weekly premium $11.70. 9 weeks, you're going to make 60 to 100% plus. Now that depends. Some weeks you'll make less on the market because your protection may go against you. but again, you'll make money. Sometimes you'll make more. When it's all said and done, as I said earlier, it's a long-term solution to a short-term problem. You will have more stock. So even if it's going up and you're giving up some on your protection, you will still be making more because you have more stock. That's how you compound out this market. So here it is the cost, and it ends up your absolute protection comes in at $277.02, $6. So again, the protection comes in at about 1.5%. Okay. Where does the money come from to prosper and compound? Well, that's a good question. I'm glad you asked it. What we did, okay, 2010 is when the weekly started. This really became an unbelievably viable model in 2010. When weekly options were born, we made up a portfolio of the most basic stocks. We did not want to create, Apples and Amazons and all these wild ones. These were all stocks that most of you own in your portfolio, either through a mutual fund or directly. But we put a portfolio together of $1 million. We put $26,316 into each one of these stocks. Okay. Today, unhedged, that portfolio is worth $2.4 million. Okay. Hedged, that portfolio is worth $3.4 million. Okay. So we've only improved by about 35% of what it was worth. Okay. Because during these times in the market, when the markets were selling off, we were actually collecting. We were buying more stock at the bottom of the market. So what we're trying to do is we're trying to pick tops and bottoms, but not because we think that way, but because the math behind the model says you need to roll your position up or down at X amount. Okay. It's very basic. It's all automated. It's all automatic, whether you use the software or whether you do it yourself manually. Everything is automatic. And here's the list of stocks that we used. I mean, Alcoa, Apple, Abbott, Allergen, very basic, simple, everyday stocks. Okay, there's no fancy, crazy movers in there. There's what the portfolio was. Okay, now, on May 16th this year, I put in my software, we bought $250,000 of the Spiders, the Russell, the Qs, losing my mind, the Diamonds, and the TLT, the bond fund. Okay, and what's happening to them now? Well, today we put in 249 basic, almost 250 in each. We bought originally 1,080 shares. We now have 1,233 shares. Okay, and our portfolio has gone from 250 to 315, from 250 to 312, from 250 to 350, from 250 to 311, and the bonds have not performed, but they've still gone up. Okay, and we have more quantity across the board. Okay, so that's how it works. Now, if you choose to go with the software, and part of today's deal is you will get an opportunity to use it for free for 90 days, but you get updates just like this. You get emails and text updates right to you as often as you want them. You actually make that decision, okay? And you decide whether you want to hedge to itself, you want to hedge to a group, which we do. You get text alerts as well, and that's how you protect yourself. This is the protection model that we're using all the time, and this is the one that gets rave reviews over and over again. Paulson appears on Face the Nation and says, our banking system is safe and sound one. And I go, if the banking system was so safe and sound, everybody would know it. Why would he have to come out and say it? We knew it wasn't in good shape. So it's the same as firing a coach. This is not Lehman Brothers. It's a new one. Okay, look, we don't have to have the same collapse. There'll be another reason, but you can bet two things. One of them it'll be about the money. It'll be about debt. Which debt? Whose debt? We don't know. Forget what they told you. You want the truth, follow the money. Okay. So here is a portfolio. This is just a sample. Okay. This is actually Tom's portfolio. Okay. Here's a basic portfolio of 429,000. Here's the different stocks that he is holding in that portfolio. Okay. And where he's holding them. So you got to break it down and where it belongs. This is a simple breakdown. So gold, we would just hedge to itself. Amazon and Bubba, we would hedge to themselves. Into the SPY, we would put the S&P stocks. And into the NASDAQ, we could put the NASDAQ stocks. Okay. And then build a hedge. And that's what we're doing. We create our own ETF out of what we own. I don't want you to sell what you have, okay? I don't want you to do anything with your portfolio. I just want you to protect what you got, okay? So I asked you when we started the 2 questions. How would you like to never sell stock again? Would I like to benefit from the next correction? If those answers are yes, I'm going to make you an offer now. Don't go anywhere because I know some questions. I'm going to answer every question, okay? I'm not losing my mind. I am losing my mind, but it's not a far loss. All right. Anyways, so I've got a new class actually starting next Tuesday, okay? It's to learn and hedge and protect your portfolio, okay? It's a 7-week course that I teach you everything from the beginning, step by step, okay? I also am including our silver package of software, which does it automatically for you, okay? That class is normally $2,500. I said I wasn't going to do this again because I did this presentation a couple weeks ago, but because I'm doing a special one today, I will do it again for $2,000. All right. Now, the nice thing about my classes is they're always different because it really depends on the markets of where I'm going to teach, but the principles are always the same. And once you sign up, you get to come back to any class as often as you would like of the hedging. So, because I do the hedging classes about 6 times a year. Okay. I only don't work in the summer. I do these classes throughout the fall and the winter. So you get to come back and relearn in case you have questions, plus the fact that you get to ask me questions all that you want anytime. Okay. So remember, hedging, it's bubbatrading.com/hedge if you want to come aboard. If you don't have a competitive edge, don't compete. Okay. Again, this is how you get started if you'd like to. No pressure. Let's see. Bubba, will you please comment on the following situation? Market goes down 32% over 5 months. We follow your instructions, but the market then stays flat for 5 years. Does the system work if the returns? Yes, it works 100%. Because remember, if the market goes flat, that's a great question. I've never been asked that question, but that's a great question. The market goes flat for 5 years. Do you know what's happening in those 5 years with those iron condors you're selling? You're creating yield. So you're collecting because the market's flat. It's not moving anywhere. So you're getting paid to wait for the market to go up again. Okay? Is the 1.5% risk per quarter or per annual? It's per the hedge. So in this case, it's for 4 months. Okay? But again, it's hard for me to explain it until you've taken the class. That risk is really not there. Okay? You'd have to go to sleep and do nothing else for the next 4 months. But that is based on when you hedge, that's your protection. But you're going to get a chance to roll that hedge, and you're going to get a chance to compound it because there's always a 2 to 3% sell-off, which is when we roll at 3%, because we have found mathematically that 3% is the number that gives us the highest return on our money. So it is a position that you're in that you will, it's not really as much as I say, but I always like to give the worst case scenario to the hedge model. Okay. That's really what I try to do. I don't want anybody to think this is not a get rich quick scheme. This is strictly a mathematical model that covers up your portfolio and protects it specifically to what you want to do. And as you read from the opening guy email of what he does with Apple and the Q, he's got 12% more of both in stock, and he's made 15%. Okay, the markets have not performed to that level. He's doing much better than the overall market, which is what this is all about. Okay, that's what the program is about. You've got any